on Larry Shover, Chief Investment Officer at SFG Alternatives now. So tell us, why are we seeing energy shares doing all right, Larry, when we've seen Brent falling below that $60 per barrel market, and while crude, relatively stable, is at $55.96?
Yeah, I just think it's a knee-jerk reaction. I mean, there is wholesale selling in the energy sector, no matter if the stock was healthy, if it wasn't healthy. So the rubber band just got completely taut. And at some point, you're going to have some short covering. You're going to have some value buying, whether it's a value patch or not, remains to be seen. But that's what happens in these markets that become completely oversold or overbought. And in this instance, just completely oversold.
So how do you make of the market movements that we've seen in the past couple of months? We saw that dip. In October, and we've continued to see the market move higher. But when you talk about that sort of taut elastic band, is that the feeling that we're getting when we saw this lift in December?
Perhaps. I look back to middle of October, just a huge correction. S&P went down to 1820, completely just out of context and just gathered a lot of momentum. I didn't think that was real, but the same thing applies to early December. It's an enormous run-up where everybody was very casual in mentioning that the S&P 500 deserves to be at 2,100 by the end of the year. And now that we're sitting on 2,000, it seems completely unlikely. But it's more about just the sentiment of traders right now, not knowing which way to turn. And that's been the story of 2014, where it seems like sentiment has ruled, psychology has ruled, not necessarily fundamentals.
Okay, talk about fundamentals, because we do, of course, have the U.S. Fed meeting today, continues tomorrow, and we are expecting to get that update coming from U.S. Fed Chair Janet Yellen, which obviously will be hanging on every word. Considerable time. Will it be there?
Yeah.
Will it not?
Yeah, that's a good question. I think that's why it's so quiet behind me right now, because people are just wondering that. I mean, a week ago, it seemed like consensus believed that considerable time would be removed, and in its place would be something along the lines of, we are going to be very careful and data dependent. And I think at the very end of the day, that's what the market expects, is some carefully chosen words of data dependency, because, the macro fundamentals are decent. I mean, overall, there's definitely potholes and things we need to be worried about, but it seems like, consumer spending around the world is up. GDP is holding its own. Industrial production, the jury is out on that. I'm not saying the stars are shining, but things are, not as bad as they could be. So that in mind, when you have diverging central banks like Japan and possibly the ECB the first quarter, that would be very good for the equity markets around the world, just keeping people out the financial repression system, forced to buying stocks.
Yes, and when we talk about the energy plays and the energy space in general, do you think that the U.S. Fed is going to specifically outline their thinking on how these lower energy prices will affect, say, global growth? Because our central bank governor here, Glenn Stevens, is quite confident that this energy story as a whole for global growth is actually very positive. Yeah,
I agree with that, something we talked about even last week. Certainly, it's not good for everybody, but the net effect is great. The last 6 months, on average, the American has saved $100 a month in gasoline. That money definitely goes somewhere else. And we look at short-term history, like 1986, 1997, when we had short-term corrections in the oil price. What that did downstream was prompted an emerging market rally, because the same thing happens there, where GDP growth does a lot better than market expectations because of that.
And do you think, though, that the Fed, in their language, will take that time to sort of draw some sort of distinction between disinflation as it relates to other forces and the disinflationary impact of falling energy prices?
I think they're going to come up with something very similar to back in the summer when Janet Yellen started talking about biotech stocks being overvalued. But I think it'll be very carefully crafted, fully recognizing that the oil drop-off of 45% is complex. However, it will definitely affect inflation and growth, but that the jury is still out and the economy is still humming along, and they will completely watch that for any kind of movement one way or the other. I mean, that's the bottom line from my point of view.
So you say that it's quite quiet there behind you as investors, as traders, hang out waiting for what the U.S. Fed is going to say. So what if this considerable time reference is dropped? What if the dot points do change considerably from the Fed's prior update? And of course, the dot points referencing, their time frame going forward. What does the market do? What happens behind you there, Larry?
Yeah, that's an excellent question. It's actually two different questions, because considerable time removal would have to be replaced with careful language that I just mentioned, and I really do believe it would. The dots forecast, if that changed considerably, I think we'd have an enormous correction in the market, because not many people are expecting it right now. I mean, the markets certainly are volatile, but that's because of what's going on with oil and Russia right now. But if the dots forecast changed in a meaningful way tomorrow, yeah, we would have a meaningful correction.
Okay, so heading into 2015, putting the Fed energy not aside, but just keeping that in the back of our mind, what else are you really keeping your eye on? Because there are instabilities out there. We had some disappointing data coming from China just yesterday in regards to the HSBC manufacturing read. We've got Europe, an ongoing problem, Greece in particular. Yet what are you watching? We've only got, really a week before Christmas.
Yeah, that's right. I continue to watch high yield, which continues to do poorly. I'm watching the yield curve. I'd love to see a steepening. It's just not happening right now. It is a little bit bothersome, but overall, I'm taking a bigger picture look and just remaining overweight equities, long the U.S. dollar. But when I talk about equities, like I talked about the week before and the week before, I still like Japan first, Europe second, hedged fully with the U.S. dollar, because I do believe with them expanding their balance sheets larger than the U.S., it'll be just a lot of upside potential for those two stock markets.